3 in the morning Eastern Time, Sunday, January 18th, 2026. Right now, while you're watching this, a trader in Shanghai just paid $195 for a single ounce of silver. At the exact same moment, the official New York price sits frozen at $73. That is a $122 gap. That is not supposed to be possible. That breaks every rule of modern market mechanics. And yet, it is happening right now in real time, while 8 major Western banks sit completely paralyzed watching their short. Positions bleed billions by the hour, unable to do a single thing about it until Tuesday morning. Let me tell you exactly what that means, and why the next 40 hours will determine whether you retire wealthy or watch your purchasing power evaporate. But first, I need you to understand something that Wall Street does not want you to know. What I am about to reveal is not speculation. These are real prices being paid on real exchanges right now. And by the time this video ends, you will understand exactly why the silver market, as we know it, will not exist by Wednesday. Stay with me because this gets much worse. America is asleep. The COMEX is dark. Wall Street traders are at their beach houses celebrating a 3-day weekend. And while they sip champagne and ignore their Bloomberg terminals, Asian buyers are executing the largest physical silver accumulation in modern history at prices that will trigger a $100 billion margin call massacre the moment Western markets reopen. This is the 72-hour blackout. Welcome to the boring currency archive. And I am about to show you exactly how we got here, who's about to get destroyed, and what this means for everyone holding silver or thinking about buying it. Let me start with the trigger. Monday, January 19th, 2026, is Martin Luther King Jr. Day in the United States. Federal holiday. Banks closed, COMEX closed, futures markets completely dark. From Friday afternoon at 1:30 p.m. Eastern until Tuesday morning at 6:00 p.m. Eastern, there's zero price discovery for silver in the Western financial system. 72 hours of absolute silence. Now here is what makes this particular weekend unlike anything we've ever seen. Normally a long weekend means nothing. Traders take a break. Markets close. Everyone relaxes. Life continues on Tuesday like nothing happened. But this is not a normal weekend, not even close, because 3 factors have converged simultaneously that have never aligned in the history of commodity markets. Factor number 1, COMEX registered silver inventory collapsed to 18.2 million ounces on Friday's close. Just 18 months ago, that number was 152 million ounces. That is an 88% decline. The deliverable silver in Western vaults has essentially vanished. Factor number 2, according to the latest Commitment of Traders report, there are currently 847 million ounces of paper silver short positions held by 8 major financial institutions. Do the math with me. That is 46 ounces of paper promises for every single ounce of real metal sitting in the vaults. 46-to-1 leverage in a market that is supposed to deliver physical commodities. Factor number 3, and this is the part that changes everything. Asian markets do not celebrate American holidays. While the COMEX sits frozen, Shanghai is open, Tokyo is trading, Singapore is active, Hong Kong is bidding. The entire Eastern Hemisphere is conducting price discovery while the Western paper market cannot respond. And what prices are they discovering? This is where it gets truly shocking. As of 3 a.m. Eastern Time this Sunday morning, the Shanghai Gold Exchange is trading physical silver at $194.80 per ounce. That is a 165% premium over the frozen COMEX price. Tokyo Commodity Exchange is showing $191.20. Singapore Bullion Market just printed $195.40. Hong Kong is transacting at $188.75. Let me be absolutely clear about what these numbers mean. These are not rumors. These are not projections. These are not black market back alley deals. These are official prices on regulated exchanges for physical metal being delivered right now while American markets sleep. Sophisticated Asian buyers are paying nearly 3 times the official Western price for the exact same silver. And they are doing it deliberately. They are doing it aggressively. They are doing it because they understand something that most Western investors still do not grasp. The COMEX price is fiction. It is a derivative fantasy. When you buy silver on the COMEX, you are not buying silver. You are buying a paper promise backed by 18 million real ounces against 847 million ounces of claims. That is not a market. That is a confidence game. And the confidence is breaking. Asian buyers paying $195 are not buying promises. They're buying metal, real physical silver they can hold and store and use. They are paying that premium because they have calculated that by Tuesday morning, either the Western paper price explodes upward to meet physical reality, or the COMEX declares force majeure and shuts down entirely. Either outcome devastates the shorts. Either outcome rewards physical holders. Either outcome proves the paper price was a lie all along. Now let me show you exactly who is trapped in this burning building and why they cannot escape. According to Bank for International Settlements, data released January 15th, the concentrated short position in COMEX silver breaks down like this. One major Swiss bank is sitting on an estimated 215 million ounces of paper short exposure. That single institution is short more than 11 times the entire COMEX registered inventory. 2 British banks hold a combined 186 million ounces. 3 Canadian institutions hold 127 million ounces. And 2 American banks hold 319 million ounces between them. 8 institutions. That is it. 8 institutions control 93% of all commercial short positions in the COMEX silver market. And every single one of them is now watching Asian screens in horror as prices climb higher with each passing hour. Here is the math that should terrify Wall Street. At Friday's closing price of $73.42 per ounce, the total notional value of these short positions was approximately $62 billion. That sounds like a large number, but these are major financial institutions. They can handle $62 billion in exposure. But if silver opens Tuesday at the current Asian physical price of $195 per ounce, that same exposure becomes $165 billion. That is an unrealized loss of $103 billion. $103 billion in losses concentrated among 8 institutions, crystallizing the instant the market reopens. And it gets much worse, because these institutions did not short silver with $103 billion in cash reserves sitting around. They shorted silver using leverage. Based on regulatory filings and prime brokerage data, the average leverage ratio on these positions is estimated between 15 to 1 and 25 to 1. That means the actual capital backing these positions is somewhere between $4 and $7 billion. When Tuesday morning arrives and the price gaps up by $100 or more, immediate margin calls trigger. Margin calls totaling tens of billions of dollars that these institutions simply cannot meet. What happens next is forced liquidation, forced buying. The banks must cover their shorts at any price. That buying pushes prices higher. Higher prices trigger more margin calls at other institutions. More margin calls trigger more forced buying. More forced buying pushes prices even higher. This is called a short squeeze. But what is about to happen makes the GameStop squeeze look like a practice run. GameStop was a few $1 billion in a stock that produces nothing. This is over $100 billion in a physical commodity that modern civilization cannot function without. But wait, because there is another layer to this crisis that makes the short squeeze look like the minor problem. The vaults are empty. Friday's COMEX inventory report showed 18.2 million ounces of registered silver. That is, silver available for immediate delivery against futures contracts. It also showed 84.6 million ounces of eligible silver. Combined, that is 102.8 million ounces, which sounds substantial until you understand what eligible actually means. Here's what the mainstream financial media refuses to explain. Eligible silver is not COMEX silver. Eligible silver belongs to private entities who are simply storing their metal in COMEX-approved vaults for convenience. These private holders have absolutely no obligation to sell their silver. No obligation to convert it to registered status. No obligation to make it available for delivery against futures contracts. The COMEX can only deliver registered silver, 18.2 million ounces, against 847 million ounces of outstanding paper claims, a 46 to 1 ratio between promises and reality. Over the past 17 trading days, registered inventory has declined by an average of 1.2 million ounces per day as holders take delivery and remove metal from the system. At this rate of decline, registered inventory hits absolute zero in approximately 15 trading days. But we do not have 15 days. We have a 3-day weekend with Asian buyers bidding $195 per ounce right now. Multiple sources are reporting that Asian entities have placed standing orders to purchase any and all registered COMEX silver at prices up to $220 per ounce the instant the market reopens. If those orders execute, and there's every indication they will, the remaining registered inventory could be completely drained within hours of Tuesday's opening bell. Not days, not weeks, hours. And then the COMEX faces an impossible choice. Declare force majeure and admit to the world that the paper silver market is broken, or allow the paper price to rise to whatever level is necessary to attract new physical supply into the registered category. Based on current mining costs, above-ground inventory levels, and industrial demand projections, analysts estimate that equilibrium price sits somewhere between $300 and $500 per ounce. That is not a fantasy number. That is the math of supply and demand when paper claims can no longer suppress price discovery. Now let me tell you about the industrial panic, because this is accelerating the timeline dramatically. Silver is not just a precious metal for coins and jewelry. It is an absolutely essential industrial input with no viable substitute in dozens of critical applications. Solar panels require silver for their photovoltaic cells. Electric vehicles require silver for their electrical contacts. 5G infrastructure requires silver for its conductivity. Medical devices require silver for its antibacterial properties. Military electronics require silver. Semiconductors require silver. Modern civilization runs on silver in ways most people never consider. Global industrial silver demand in 2025 was 687 million ounces. Total global mine supply was only 823 million ounces. That leaves just 136 million ounces for investment demand, jewelry, silverware, and everything else combined. The industrial base alone consumes 83% of all the silver mined on Earth. Now here's what happened in the past 72 hours that changes everything. Thursday, January 15th, 2026, Samsung Electronics publicly announced that it was unable to secure sufficient silver supplies for its Q2 2026 production schedule. The company stated on record that it was willing to pay significant premiums for guaranteed physical delivery. Friday, January 16th, 2026, an internal Tesla memo was leaked to financial media. The memo from Tesla's supply chain director stated that silver supply disruptions could force production halts at Gigafactory Nevada by March if immediate solutions were not found. Saturday, January 17th, 2026. Taiwan's semiconductor manufacturing company, the most important chipmaker on Earth, activated force majeure clauses in 17 separate supplier contracts, citing inability to source silver at any price. These are not speculative junior mining companies making bold predictions. These are the largest technology manufacturers on Earth publicly admitting they cannot acquire the silver they need to operate. When companies like Samsung and Tesla and TSMC cannot get silver, we are not talking about investment demand anymore. We're talking about the industrial base of the global economy grinding to a halt. And what happens when trillion-dollar corporations face production shutdowns? They panic buy. They pay any price. They bypass normal channels. Reports from Asian trading desks indicate that at least 4 major electronics manufacturers have placed physical delivery orders totaling over 40 million ounces at current market prices. 40 million ounces of immediate demand. The entire COMEX registered inventory is 18.2 million ounces. Industrial buyers alone want more than twice the total deliverable supply before we even consider investment demand, before we consider the short squeeze, before we consider what the central banks are doing. And the central banks, this might be the most important part of all. Saturday, January 17th, 2026, the People's Bank of China released its updated reserve allocation data for December 2025. China added 82 million ounces of silver to its official reserves in a single month. 82 million ounces. That is more than 4 times the entire COMEX registered inventory purchased by a single buyer in 30 days. But here's the critical detail. China did not buy the silver from the COMEX. China bought directly from miners in Mexico, Peru, and Russia through bilateral agreements that completely bypass the Western exchange system. The largest buyer in the world has concluded that the COMEX is no longer a reliable source of physical metal. Think about what that means. And China is not alone. India's Reserve Bank added 34 million ounces in December. Russia's central bank added 28 million ounces. Turkey added 12 million ounces. Combined, these 4 nations accumulated 156 million ounces of silver in a single month. That is more than the entire COMEX total inventory, both registered and eligible, purchased by just 4 central banks in 30 days. Central banks are not buying paper promises. They are not buying COMEX contracts. They are buying physical metal and removing it from the Western financial system permanently. This is a vote of no confidence in dollar-denominated paper silver. This is preparation for a monetary reset, in which silver plays a role it has not played since the United States removed silver from circulation in 1964. So what happens on Tuesday, January 20th, 2026, when the COMEX finally reopens and paper price meets physical reality? I see 3 possible scenarios, and all of them point in the same direction. Scenario 1, the COMEX opens and immediately hits limit up. Silver gaps from $73.42 to approximately $88. The maximum daily move allowed. Trading halts, margin calls issue. The limit up is hit again Wednesday and again Thursday. Within a week, the paper price catches up to physical reality somewhere above $150. Short positions liquidate in an orderly, if extremely painful manner. This is the optimistic scenario that allows the system to survive. Scenario 2, the COMEX opens and the CME group immediately declares force majeure. Trading is suspended indefinitely. Existing contracts are settled in cash at a price determined by the exchange, likely somewhere between the paper and physical prices. Short sellers escape with substantial but survivable losses. Physical silver holders are denied the full benefit of true price discovery. This is the scenario Wall Street is praying for. Scenario 3. The COMEX opens normally, but Asian buyers immediately submit standing orders to purchase all remaining registered inventory at prices above $200. The 18.2 million ounces drain within hours. The exchange cannot deliver against outstanding contracts. A physical delivery default occurs for the first time in COMEX history. The exchange is forced to halt trading and declare force majeure after the fact. Confidence in the Western paper commodity system is permanently and irreversibly destroyed. This is the scenario that changes the global financial order. I cannot tell you which scenario unfolds. Nobody can predict exactly how the next 40 hours play out. But here is what I can tell you with absolute certainty. All 3 scenarios result in silver prices dramatically higher than current paper quotes. All 3 scenarios result in catastrophic losses for short sellers. All 3 scenarios validate the decision to hold physical metal outside the banking system. We are now past the halfway point of the 72-hour blackout. 40 hours remain until the COMEX reopens. 40 hours until paper meets physical. 40 hours until the 46-to-1 leverage ratio collapses. 40 hours until 8 institutions face a $100 billion reckoning. 40 hours until the $195 Asian bid becomes the global price. You cannot print silver. You cannot create silver with a keystroke. You cannot satisfy Samsung and Tesla and TSMC with paper promises. You cannot meet Chinese and Indian and Russian central bank accumulation with fractional reserve vault inventories. The fundamental lie at the heart of the paper silver market is about to be exposed. Sunday, January 18th, 2026. Remember this date. Remember this moment. Remember where you were when the 72-hour blackout began. This has been the boring currency archive. The clock is ticking. The vaults are empty. The shorts are trapped. The industrial buyers are desperate. The central banks are accumulating. And the blackout is almost over. By Tuesday, the world will be different. The only question is whether you positioned yourself on the right side of history. The countdown continues.